Hello everyone. Today we talk about the seesaw between price and earnings and how it affects the equity markets. Last 2 years, you have seen a time correction in Indian equities, turning from expensive to currently fairly valued. What we experienced was that the prices were rising faster than earnings. What this means is that the stock market was reacting to something which was going to happen. They were discounting on earnings where they were expecting that the companies will do well. We entered 2025 with expensive market. On top of it, we saw a trade war which emerged between US and India and even the other economies. We did see oil prices rise this year with the Middle East tensions, and definitely that has affected not only the oil prices but even the global trade. On top of it, we have seen sustained outflows from FIIs in the last 1 year, and this has also affected equity markets. But the most important thing is what has happened in the last 2 years, which the markets have not seen. Markets entered, like I was telling you, in 2024, we were expensive. Earnings were growing, but the prices were growing faster than earnings. We saw that the markets didn't go anywhere, they were sideways. You did see a lot of expensive valuation stocks fall, and that is where you have seen that there's been a good, healthy consolidation which has happened in the last 2 years. But is it the right time to invest? If you ask me, definitely this looks like the last leg of the 2 years of a correction which we have seen in Indian equities. There are multiple reasons to it. The earnings have been very good. The corporate earnings have been healthy. A few sectors like IT, which have not done well, but overall the earnings have been much better than expected. Second was there was a lot of talk going on about El Nino effect. What actually has emerged is that we are in a very normal monsoon. So that is a second positive. With RBI intervening, the rupee has stabilized. On top of it, where FII flows have turned positive. But I do not feel that the FIIs are going to come back in a hurry. There will be at least 6 to 8 months before the FIIs come back when they experience that one, the Indian equities have become fairly valued compared to the global peers, as well as there is an alternative to the AI play. So that's where the Indian equity FII flows can come in. Eventually, markets will reverse to the mean, and we do expect that valuations will help inflows come back. The important thing is there will be multiple reasons for the stock market to either rise or fall, but the important thing is valuations. The seesaw between earnings and prices is what remains. And wherever you see that the earnings have become more attractive, you will see that the prices will eventually catch up. Maybe from next year onwards, we expect that the markets can see some kind of, after the 2 year consolidation, you can see the markets can start giving you positive returns. Sector specific, if you ask me, I think there are broadly two, three themes which I feel will play out very well. One is manufacturing. Two, because of the rupee devaluation, you will see export-led sectors do well. And third is healthcare. In spite of all the noise, all the different geopolitical situations emerging, what remains is the seesaw between corporate earnings and equity prices.